Hi, my name's Chris Davies and I'm one of the investment managers of the Baillie Gifford European Growth Trust. Conveying a message of optimism feels quite countercultural these days, but this is exactly what I want to do. In this short video, I will discuss performance, what we're seeing from companies, give an update on our private companies, and finally explain why this environment suits us as growth investors. "2023 has been a poor performance year for us and our clients. Conditions have certainly not favoured our style of investment, with risk appetite at a low ebb and the feeling of uncertainty shortening investment horizons for many. This has led to several strongly negative reactions to company results for highly profitable companies with long growth runways, like Adyen in payments and Sartorius Stedim in bioprocessing, both selling off due to near-term disappointments. We're much less worried. The portfolio has had long-standing exposure to fast-growing companies which have prioritised long-term growth over near-term profits, which has sometimes detracted from performance, even as those companies have made material progress towards their goals. In some cases, such as video games company Embracer and renewable investment company Arca Horizons, we have judged that the odds have been stacked against sustained progress by the shift in the economic environment and have sold them as a result. We will always make some mistakes. But our mantra throughout this period for companies has been don't waste a crisis. And what has been pleasing is that most companies in the portfolio certainly aren't. Operational performance has generally been good, and we are seeing many affirming signals that our companies are taking advantage of this environment, investing while peers retrench, carrying out acquisitions, and buying back shares. For example, Spotify, the audio streaming platform, has begun to reduce its costs and is beginning to see the fruits of its investments of the past few years, something which we believe should result in higher profits. This ought to be a high-return business, given the lack of capital involved. Allegro, a Polish e-commerce marketplace, has been leveraging its scale and competitive edge by increasing prices for its services, while peers such as Shopee exit the market. Meanwhile, Topicus, a serial acquirer of vertical market software businesses, is continuing to spend almost all of its cash flow on acquisitions, generating high growth rates as it consolidates this very fragmented industry. Low-cost airline Ryanair is gaining share across the board and enjoying some of its best years. It even recently announced the introduction of an ordinary dividend permitted by the company's tremendous cash-generating capacity. Now, stock markets have been volatile, far more volatile than the underlying fundamentals of companies. We've been taking advantage of such dislocations, making several opportunistic purchases of structurally advantaged growth companies trading at appealing valuations. These include French semiconductor business Soitec, whose performance-engineered substrates are critical components for the semiconductors we need in our phones and electric vehicles, and German company Hyperport, whose mortgage origination platform Europace is allowing mortgage brokers to gain share in the German mortgage market from traditional banks. We've also added luxury companies LVMH and Moncler, one stalwart and one upstart, which we believe should be able to compound earnings at attractive rates for a long time. We think the portfolio is attractively positioned, something which bears out in the portfolio's characteristics. Based on consensus estimates, at the end of October, the portfolio is expected to deliver over 4 times the revenue growth of our benchmark index over the next 3 years, while the portfolio's earnings growth over the same period is expected to be more than double that of the index. These levels of growth are not going to be generated via a debt binge either, with the portfolio's net debt to equity ratio standing at 0.3 times versus 0.5 times for the index. Meanwhile, the portfolio's forward price to earnings multiple has contracted from 32 times in December 2019 to 18 times in October 23. So our companies have stronger growth prospects, stronger balance sheets, and are trading at attractive valuations. One of the biggest points of differentiation for our portfolio is the allocation to private companies, which stands at around 11%. We think giving investors low-cost access to private companies that would otherwise be unavailable is an attractive proposition. Companies are staying private for longer, and many of them are in the fortunate position to be able to choose their investors. We think our reputation as long-term growth investors and our ability to invest in both private and public markets mean we are advantaged when it comes to accessing companies. As a result, we've been able to invest in some of Europe's fastest growing innovative private companies, such as Northvolt, Europe's battery champion, which is rumoured to be turning public in 2024, Sender, a digital road freight forwarder, and most recently Bending Spoons, an Italian software company with a unique approach to monetizing apps. We're excited to be able to offer investors exposure to these companies, which have exceptional potential payoffs. We have underperformed over the past 2 years. This is irrefutable. Interest rates have risen and valuation multiples have fallen. This has hurt us. While we continually ask ourselves what we could have done differently, Baillie Gifford has been managing European portfolios since 1985 and has experienced poor performance before. Many of our most successful companies have been through similarly difficult bouts. Just as those companies did, we emerged from each one in a stronger position. Looking to the past is for learning lessons, while looking to the future helps us grasp opportunities. And with that perspective, we are in a bullish mood. The companies we invest in typically grow faster than the index, and we would expect this to continue for far longer than 5 years because of the secular growth trends they benefit from. We believe that they are of higher quality, have unique corporate cultures, have a preference for low or no debt, and are run by some of the best capital allocators in Europe, which makes them both resilient and opportunistic in difficult times. This, to our minds, makes for an attractive combination and puts the trust in a strong position to deliver the returns its shareholders would expect of it over the long term.